So tell us about this increase in the range and the demand that you've been able to determine.
So with Fitbit, this is a company that comes out, it's profitable, it has almost $1 billion in revenue. So investors are obviously excited about this company. Now, the demand that we're experiencing right now is unbinding demand. So bankers will assess these so-called indications of interest, which say we want shares at a certain price. They were able to generate enough demand at the high end of the previous range in order to raise it. Now, likely when this happens, we'll see pricing take place at the higher end of the boosted range. Otherwise, why would you raise the range to begin with? Which would indicate that Fitbit is a $4 billion company.
Okay, so I totally get that as far as tech startups go. The fact that they are in the black and they're growing so fast is huge. I also just read a stat that they have 85% of the wearable fitness tracker market, which sounds huge. But my question, Leslie, is about the growth forecast. I mean, how much longer can Fitbit continue to grow at this rate, particularly given the fact that right now the most powerful technology companies in the world, Apple and Samsung, are trying to get into the market to compete with them?
It certainly sounds a lot like another device company that we all followed very closely back in 2006, and that is BlackBerry. Back, if you remember, this company was experiencing new competition with the iPhone, which was coming out. It also was undergoing some patent lawsuits, just like Fitbit did. And one of the key lessons, I think, from BlackBerry that we could take away is that Fitbit needs to continue innovating. It needs to continue meeting its customers' expectations in order to take on competitors like Apple.
James Gellert, what do you like about this IPO? And on a scale of 1 to 10, is this a good IPO or a bad IPO?
I think this is a good IPO. And, of course, it's coming at a time when there haven't been a lot of great IPOs to compete with it. And I think Leslie's absolutely right. Coming out with a company that's a technology IPO that is profitable sets it apart. It puts it in camps like the GoPro IPO of last year. So I think this is a very strong company on our financial health rating scale, which is 0 to 100. We rated an 87. That's very, very high. It's actually quite close to where GoPro was when it came out. What I really like about Fitbit, despite the fact that it's a relatively small company, and that is a concern people should be focused on, is that it has managed to grow and grow in a relatively short period of time, not just in revenue, but it's been able to grow in margins. So being able to grow but not having to expand your cost base exponentially to get that growth so you can continue to be profitable in those very early big growth years, that's a sign of a very efficient company and a sign of a profitable one.
So you give Fitbit a rating of 87.
That's
Maybe
right.
Just explain what those ratings were. We were comparing it to Alibaba and Etsy. You say the appropriate comp, though, for Fitbit is GoPro. How come?
Well, I suspect that was contrasting it with some of the recent tech IPOs. When you look at it against GoPro, Sony, even Apple, there are a lot of very distinguishing features about it. And Apple obviously is a much, much bigger company. Sony is a much bigger company. GoPro's double in revenue, but they have almost the exact same gross.
I guess what I'm asking is why should we care about these ratings?
Well, the ratings are looking at a wide variety, over 73 different efficiency measures in the company. Everything from cost structure efficiency, working capital efficiency, leveraging, liquidity, earnings quality, profitability. So the range of those things, the myriad changes that go on in those ratio analyses every single quarter, compared against now 12 million company years worth of financial data, profiles the company as being extremely strong.
Leslie, what are we talking about? Goes out tomorrow?
It'll price tonight after the close, and
so
then
what
we'll
are we
start
talking?
trading.
It was 17 to 18 or 19?
19, exactly.
19.
So we'll see. There's a big day of trading that has to get done.
Right. So James, does the stock go up? Let's say you get a chance, you get to buy, let's say Friday. Don't do it Thursday, you buy it Friday. Does stock go up for the rest of the month?
Show me a recent IPO where the stock doesn't go up.
That's true. So Box and Etsy, right? You know better than me. They both spiked at the open, but it's been totally soggy since then. Is this a good time to go public?
So the thing is with those two companies, and I think Fitbit could experience a little bit of this as well, those two companies experienced a lot of retail demand. Consumers who use the product, who then buy in, have little price sensitivity of buying the shares on the first day of trading when they're spiking. Then if something goes wrong, if they miss earnings estimates, if they have some sort of PR debacle, then they tend to do more panic
like
selling than the institutional investors. Exactly.
Like a little lawsuit.
Like a lawsuit.
Right.
Like
that makes sense, though, that retail buyers boost the IPO day.